Hi everyone, hope you're well. If you are not already following us on the socials at Future Accounting, please do. Our aim is to help as many small businesses as possible under our 3Ps future prosperity model, be to protect, preserve and prosper, which at the centre of all that is the health, wealth and prosperity of all our clients and our team. You may have seen a recent article we posted regarding rental property deductions. We are doing a follow-up article on this, comparing residential and commercial investments, so keep an eye out for that over the coming week. It is a question we get asked a lot. So for today, residential rental properties, they are always on the ATO's hit list, and it's surprising how many people get this wrong. So we'll break down some of the common misconceptions. So rental income and allowable deductions must be recorded in the tax return of the legal owner per the title. So if you are a couple and both the properties both in your names on the title 50-50, then you can record 50% in each of your tax returns. However, if you are a couple but the investment property is only in, say, the wife's name, only the wife can record the income and expenses associated with that property in her return. Why is there a problem in this area when it seems fairly clean cut? Well, some people try and get away with recording the net loss if the property is negatively geared, meaning expenses usually as a result of interest claims result in a net loss of the property. They try and push that net loss into the higher income earners tax return, which is a big no-no. So be careful, this is hot on the ATO's list. Travel expenses, since about 2017 the law changed and said no more travel claims. So if you live a few hours away or live interstate, you cannot claim for the travel to come and inspect or do anything for your rental property. So be wary of that. Capital expenses, claiming improvements 100% in the year incurred is a no-no. So capital items such as fully replacing a kitchen, a new oven or a split system are all depreciated over the useful life of the asset, which the ATO sets out. So if you have big repairs and maintenance claim in your tax return against your rental property, this is likely to trigger a review from the ATO. So making sure these expenses are classified correctly are very important. Loans are always an interesting one. It's a common thought by some taxpayers that you get to claim the loan repayments. This is not correct. It is only the interest and bank charges that you get to claim, and in proportion and not the portion of the principal. Okay, so you can only claim the interest and charges. Another one with loans is the area being scrutinised is that the taxpayer, if you have an existing loan, for example, and you use that loan to purchase a rental property, or if you already have an investment property and you draw on that loan to purchase something else, particularly a personal asset, you can only claim the interest and charges directly related to the investment property portion, meaning if you did have the loan for any other purpose and not related to that investment property, particularly if that was the personal asset, you need to apportion the interest and charges accordingly. It can get messy. So we always do encourage clients to keep investment property or income generating assets, loans, separate to their personal loans, particularly their main residence, for clarity and assurance. A really good mortgage broker will always structure your loans and work with your accountant to make sure you are structured correctly and are obtaining the best outcome for your circumstances overall. And last one for today, if you purchase an investment property and it requires repairs and maintenance, improvements or substantial renovations before you can put tenants in, these costs are not deductible. Okay, so they are regarded as capital. We can add them to the cost base of the property. So if you do sell the property in the future, the cost will be reflected in the cost base of the property. We can't claim them 100% in the year that you do. The rule is the property must be genuinely available for lease. So a reasonable person comes along, wants to rent it out, it needs to be able to, for that person to be able to basically walk in. So if it's been advertised to an agent, it needs to be able to be lived in pretty much straight away. Okay, so a lot of people try to claim these costs 100% in the year incurred as repairs and maintenance. This is incorrect. So if the ATO sees big, large repairs and maintenance in that year, they're going to probably review it. So we'll leave it there for today. Key takeaway, make sure you are including the rental income and expenses in the correct tax return and classifying the expenses correctly. We always encourage you to chat with us, chat with your advisor, pre-plan timing of large improvements. For example, And if in doubt, always check with your advisor. Please share this so we can help as many people as possible.